So you want to own a bank in America, not invest in one, not put money in an index fund, actually own the building, the vault, the tellers, the whole operation. Sounds like a rich person fantasy, but stick with me because the real numbers behind this business will surprise you. Owning a bank is legal, it is possible, and people do it every single year, but almost nobody explains what it actually takes or what happens once you are inside. And that is exactly what we are covering today. Picture a small brick building on Main Street, an American flag outside, a drive-through window, and a sign with a name nobody outside that town has ever heard of. That little building is a licensed money machine. And once you understand how it works, you will never look at your own bank account the same way again. Let's talk about getting in the door, because this is where most people quit before they even start. First, you need to knock on the door of the Federal Deposit Insurance Corporation, the government agency that protects customer deposits, and decides who gets to play in this game. They will ask you for one thing before anything else: real money sitting in an account untouched, roughly $20 million of your own capital. That number moves depending on the state and the city. A bank in a small town in Ohio needs less than a bank trying to open in downtown Miami. On top of that $20 million, add another $200,000 for lawyers who specialize in banking law, and another $300,000 for consultants who study your local market and tell you if your idea even makes sense. Then comes the real test, a document called a banking charter application. Imagine a business plan that runs 800 to 1,500 pages long, covering every single detail of how your bank will operate, who will run it, and how it will survive a financial crisis. Regulators take that document and disappear with it for 18 to 24 months, reading every page, checking every number before they give you a yes or a no. If you make it through, you walk out with something incredibly rare, a license that lets you take money from strangers and lend it back out to other strangers while collecting a profit on both sides. Now, if 2 years of waiting sounds unbearable, there is a faster door: buying a bank that already exists. In 2000 and 2005, a California bank bought a smaller community bank worth around $658 million in total assets for a price of about $64 million. Small community banks usually sell for about 1 to 1.5 times their book value. So a bank holding $200 to $300 million in assets could cost you somewhere around $40 million. For that price, you skip the 2-year wait, you inherit real customers, real branches, trained staff, and a license that already works. Across the ocean, the entry price drops even further. In parts of Europe, a specialized banking license can start around $5 to $10 million in regulatory capital, which explains why so many financial startups choose to launch there first, before ever touching American soil. So why would anyone go through all of this trouble? Because of one simple trick that most people never think about. When you put $1,000 into your bank account, the bank does not lock that money in a vault and wait. Back in March of 2020, the Federal Reserve, the central bank that controls the entire American banking system, quietly dropped the reserve requirement all the way down to 0. Before that change, banks had to physically hold at least 10% of your money on the side, untouched, just in case. Now that rule is gone, which means your money is free to be put to work almost immediately. Here is the part that breaks people's brains a little. When the bank lends your neighbor $200,000 for a mortgage, it does not pull that money from a drawer somewhere, it simply types the number into his account. And that money did not exist the second before. Licensed banks are allowed to create money like this every time they issue a loan, as long as they stay inside strict capital rules. And once the loan gets paid back, that same money quietly disappears from the system. In the meantime, the bank collects interest on money it never actually had to earn first. Let's put real numbers on this. Imagine a customer keeping $10,000 in a savings account. The bank pays that customer $50 a year in interest, roughly 0.5%. That same bank then takes that exact same $10,000 and lends it out as part of a mortgage at 7% interest. The borrower now pays the bank $700 a year. The customer earns $50. The bank pockets $650 in pure profit on money that technically belonged to someone else the entire time. Multiply that gap across every single account inside a large bank, and you start to understand the real business model. One of America's biggest banks pulls in close to $100 billion a year from this gap alone. And banks have a second income stream that is even more aggressive: credit cards. Right now, Americans owe over $1 trillion in credit card debt combined, with average interest rates sitting around 21%. Picture a customer carrying a balance of $5,000 on their card, paying what feels like a responsible $100 a month. In reality, about 90 of those dollars goes straight to interest. Only $10 actually reduces the debt. At that pace, it takes around 10 years to pay off, and the customer ends up handing the bank about $7,000 in extra interest, on top of the original $5,000. But here is what nobody puts on the brochure, and it is not what you think. Forget bank robbers with masks and getaway cars. That threat has actually dropped by about 80% over the past 20 years because robbing a bank in person barely pays anymore. The average haul today is around $5,000, nowhere close to what you see in the movies. The real danger to your bank comes from two very different directions: panic and people already inside the building. Let's talk about panic first. In March of 2023, Silicon Valley Bank, a major American bank holding over $200 billion in assets, collapsed in less than 48 hours. The bank served startups and tech founders who all knew each other, who all talked in the same group chats, and when rumors started spreading, everyone tried to pull their money out at the exact same moment. In a single day, $42 billion left that bank through phone screens, not through teller lines. That is called a bank run. And it happens because banks never keep all your money sitting there waiting. Most of it is tied up in long-term loans and investments that cannot be turned into cash overnight. The second hidden danger is even harder to picture because it comes from inside the building. Roughly 60% of all money stolen from American banks over the past decade came from the bank's own employees. A loan officer approving a fake loan for a family member, a teller quietly skimming cash over the years. Someone in the technology department with access to systems nobody is watching closely enough. So if you actually want your bank to survive longer than 48 hours, here are the rules that matter. First, spread your customers across different industries and different backgrounds. Never let one single group of people hold too much of your deposits, because when that group panics together, they pull their money together too. Second, be careful where that money actually goes. Once it leaves your vault, do not tie up short-term customer deposits into long-term investments that lose value the moment interest rates rise. That mismatch is exactly what destroyed Silicon Valley Bank. Third, watch closely who you are lending to and what they use that money for. Hundreds of regional banks nearly collapsed after loading up on loans for office buildings that emptied out once remote work became normal. Buildings sitting half empty are not worth what they used to be. And finally, build a culture where employees cannot quietly take advantage of the system, strong internal checks, real oversight, and constant auditing. Because the biggest threat to your bank might already be wearing a name tag and standing behind the counter. Now let's put the whole picture together and answer the question everyone actually came here for. How much money can you really make doing this the right way? Picture a small community bank. You bring in your $20 million in capital plus $500,000 for lawyers and consultants. The first 3 years you will likely lose money, and that is completely normal in this industry. By the 5th year, if you played it smart, your bank could be sitting on around $350 million in assets, bringing in about $14 million a year in pure interest income, plus another $2 million from fees and card products. After paying staff, branches, technology, and regulators, you could walk away with somewhere around $4 million in profit every single year, and most owners build that business for about 10 years, then sell it to a bigger regional player, walking away with roughly 4 times what they originally put in. Now picture the bigger version, a regional bank holding $20 to $30 billion in assets spread across multiple states, hundreds of branches. That size of operation can bring in $700 million to $1 billion a year in interest income alone, plus hundreds of millions more from fees, cards, and wealth management. After all the costs of running an operation that large, you are looking at around $400 million in profit every single year. Not bad for an industry that has figured out how to sell people their own money back to them with a profit margin attached. That is the real story behind owning a bank in America. Expensive to enter, brutally regulated, but built on a machine that quietly prints profit every single day it stays open.